of the most commonly used terms in portfolio creation is diversification. Everyone seems to know that it is extremely important. However, few people know how to implement this in their portfolio strategy. In this video, we're going to discuss three main elements of diversification. So what exactly does the term mean? How does it help your portfolio? And what are the different types of diversification? So what is diversification? It is the process of allocating money across different asset classes, instruments, and strategies. Different asset classes play different roles in the portfolio. For example, debt instruments generate stable income, equity delivers high capital growth, and gold protects against inflation. A scientific combination of all the asset classes ensures stable returns across different market scenarios. So how does diversification help? One of the keys to successful investing is aligning the investor's portfolio strategy with high risk tolerance. This ensures consistent returns and allows the investor to stay invested rather than panic sell or change his or her allocation. Different asset classes behave differently during different market environments. Two examples to demonstrate this are, between Jan 2008 and Jan 2013, Indian equity markets in India delivered negative 5.43% returns, whereas gold in the same period delivered a 137% return. In contrast, between 2013 and 2018, equity markets gave 77% returns between this period, while the investment in gold gave 0.02% returns. Now imagine if you were invested in equity between 2008 and 2013 and decide to move your investments to gold after that period. One may argue to the contrary, but as all of us know, successful market timing is pure luck. Therefore, it's important to have allocation to different asset classes to ensure consistency of returns across different market cycles. Investing in a strategy with a higher risk than the individual's tolerance can lead to untimely exit and result in losses. Conversely, being too conservative increases the risk that the growth rate of your investments won't keep pace with inflation. Diversification is the most reliable way to balance risk and reward in the investment portfolio and helps the investor in staying invested during periods of extreme uncertainty to achieve their financial objectives. So there are different types of diversification as well. Some important diversification strategies are asset class strategy, instrument, currency, and geographic diversification. Let's try to understand these a bit more in detail. Asset class diversification. Different asset classes perform differently over a specific period depending upon the range of factors like interest rates, economic growth, liquidity, etc. To ensure consistency of returns, it is advisable to allocate money across different asset classes like equity, fixed income, gold, and real estate. You also have strategy diversification. Each asset class has multiple strategies. Equity exposure can be taken through passive and active strategies. Fixed income exposure can be taken through hold to maturity and mark to market strategies. Real estate exposure is possible through yield and growth strategies. There should be a right blend of these strategies in the portfolio to achieve the desired outcomes. There are different instruments as well that you can look to diversify. Investing in different instruments within the asset class enables instrument diversification. These instruments are managed by different fund managers. Ideally, allocation should be diversified across fund managers. Currency and geographic diversification. Diversifying investments across other geographies and currencies can guard the portfolio against country and currency specific risks. We hope you found this useful. Put your questions in the comments below and our team will come back to you very, very quickly. Thank you.